Hello viewers, so welcome to my channel. I'm Hashim. I got so many comments from my viewers to give the format of the question paper of income tax for the assessment year 24-25. So this video I'm specially preparing for those students who have not fully prepared regarding the subject. Just before examination, they want to just have the view of all the provisions so that they can be able to clear the examination. For them, I'm preparing this video. In this video, first of all, the format I'm explaining, then what are the different types of questions. The format will be the question paper for income tax is for 80 marks. Section A, 20 marks and section B, 60 marks. In section A, 8 questions will be given. Each question carries 4 marks. So 5 4s are 20. So 8 questions will be given. Out of 8, you have to attempt 5 questions. And 3 you can leave it choice. Each question 4 marks. So 5 4s are 20. Section B, 5 questions are there. Each question carries 12 marks. So 12 into 5, 16. Now how the questions will be? Internal choice will be there. First 8 questions will be in section A. 9th question onwards we have in section B. So 9th A or B. That means you have to attempt either A question or B question. B bit. So A bit and B bit. So 9th A or B, that will be from unit number 1. Normally A bit and B bit both will be theory question. No problems are there in unit number 1. Very rarely they may ask a problem, but chances are more that you will get both theory question for 12 marks for 9A or B. Then 10A or B, unit number 2. In unit number 2, income from salaries. So one theory question will be there, A, or B, one problem will be there. So you can attempt either theory or problem. But if you want good marks, you have to attempt the problem. So A or B. This is income from salary, second unit. Then third unit is income from house property. From income from house property again, 11th A or B. A is theory and B you will get a problem on income from house property. Then 12th, unit number 4, 12th A or B. That means A will be theory and B will be problem. This is from profits and gains of business or profession. It is called PGBP. So PGBP, one theory or one problem. Last question, 13th question is from unit number 5. In this unit, capital gain and income from other sources. These two heads are included in unit number 5. So one theory question you will get and one problem you will get. Either from capital gain or from income from other sources. So this is the complete format of your question paper of 80 marks. Now, section A. In section A, one problem and 7 theory questions may be there, or 2 problems and 6 theory questions may be there, or sometimes all the 8 theory questions will be there in section A. So you have to give more importance to theory. Problems also. In the coming video, I'll give the short problems for 4 marks, which they may ask. So you must be prepared whether problem is given or theory is given. In this video, only theory explanation, but next video, I'll give you all problems of 4 marks. Clear? Now, then most important theory questions. See here. Briefly, with full concentration, if you listen the lecture, definitely you can write tomorrow's examination with full confidence, without fear. Confidently you can write. But follow my instructions. While watching the video, keep a notebook, calculator, pen ready. Whenever I explain some important provisions, immediately write it down. Immediately write down. Then you can be able to remember. You must have the writing skills, and particularly income tax, so many provisions are there. Now, most important theory questions. I have analyzed, I have made a lot of research by studying the pattern of the question paper and what sort of questions they have asked. I have analyzed all the questions and found these 10 questions are Very important, most important questions. We'll discuss that. Then after that, other important questions I'll explain. First of all, what do you mean by perquisite? Perquisite is any benefit, whether in cash or in kind, given by the employer to employee apart from basic salary. So apart from basic salary, some kind of benefit either in cash or in kind will be given by the employer to employee. That is called a perquisite. Not only employee, but also to their family member. This benefit which is employer is giving to employee or employee's family member, that is called perquisite. Examples of perquisite are rent-free accommodation, motor car provided by the employer, or monetary obligation of the employee met by the employer, insurance premium of the employee paid by the employer. These are the examples of perquisites. Perquisites are classified into three categories, like perquisite taxable to all employees, perquisite taxable to specified employees, and perquisite are completely tax-free. This much is enough for 4 marks. So in 4 marks question, at least half page you have to write the answer. Right? Second is, what is bond washing transaction? A bond washing transaction is an act where an SSC will transfer some asset just before the due date with an agreement that after the due date he will repurchase it. The purpose is to avoid the tax. Simple example of bond washing transaction is, if an SSC is in high income group, his tax liability is more. So what he will do, just before the due date of interest on those securities, he will transfer that security to another person who is having low income, with an agreement that after the due date, after you receive the interest, I'll again take back, repurchase the security. The purpose of this selling the security and again repurchasing is to avoid the tax. That is called bond washing transaction. If bond washing transaction takes place, the assessing officer will find out whether the motive is to avoid the tax, then only he is doing that, then transferor is liable to pay tax on that income on that security. If the SSC proves to the income tax officer that I have done this without intention of avoiding the tax, and in the past also I have not done such act, if it is genuine transfer, then Income Tax Act will not make him liable. The transferee is liable to pay the tax. Next is write about block of assets. Income Tax Act has given the provision regarding depreciation. The depreciation will not be individually calculated on every asset. The depreciation will be calculated on the block of the asset. The block of the assets means a group of assets of the same nature and having the same rate of depreciation. A group of assets of the same nature and the same rate of depreciation, that is called block. So Income Tax Act has given different blocks for different assets. For example, block 1, 2, 3, 4, 5. These 5 blocks are given for building. Building used for residential purpose, building used for commercial purpose, and temporary structure. Different rates are given for each block. Block number 1, building for residential purpose, 5% rate of debt. Second, block number 2, building for non-residential purpose, depreciation rate is 10%, like that. For furniture, a different block is given. For plant and machinery, different block is given. For motor lorries, motor cars, separate. So different rate of depreciation has been given for different block of assets. Next comes write about indexed cost of acquisition. In case of capital gain, to find out the income from capital gain, we take the consideration received minus cost of acquisition. Suppose an asset is purchased some 30 years back. Now he is selling. So do you think that the purchasing power of money today and 30 years back it is same? No. So we cannot compare today's sale consideration received with the purchase price of 30 years back. You cannot compare. In that case, indexed cost of acquisition will be applied. The meaning of indexed cost of acquisition: increased cost of purchase. The purchase price have been increased, inflated due to the inflation or due to purchasing power of money has come down. Example, if the purchase price some 30 years back was 5 lakh, today the sale consideration is 30 lakh. 30 lakh is the sale consideration today we have received. We have purchased 30 years back 5 lakh. So we should not say 30 lakh minus 5 lakh, 25 lakh is the capital gain. On that tax is to be payable. It's difficult. So for that purpose, what Income Tax Act has done? Inflate the purchase price. So we will calculate indexed cost of acquisition. So indexed cost of acquisition means the increased purchase cost or inflated purchase cost. How to calculate? Actual cost into index number of current previous year. Current previous year index is 348. Remember, previous year is 23-24. Assessment year is 24-25. The previous year 23-24, the index number is 348 given by the government, divided by index number of the purchase year that will be given in the problem. So indexed cost of acquisition is equal to purchase price into index number of current year divided by index number of the previous year, index number of the purchase year. That's it. Now what is net annual value? The net annual value, NAV, we get by deducting municipal taxes from the gross annual value. In computing the income from house property, first we calculate the gross annual value by considering the municipal rental value, fair rental value, actual rental value, standard rental value. By considering all these 4 rental values, we calculate GAV, gross annual value. From gross annual value, subtract municipal taxes paid by the owner. After deducting municipal taxes, the resulting figure is called net annual value. From net annual value, if you deduct deductions under section 24, 24A and 24B, then you will get income from house property. Next comes write about tax-free securities. Securities are the investments which an SSC will make in buying the shares, debentures, bonds. Actually, security consists of fixed income security like debentures or bonds, not shares. Shares will not come under security. So tax-free security means the security on which the tax will be paid by the issuing authority. So the tax-free security may be government tax-free security or commercial tax-free security. If it is a government tax-free security, the government will pay the tax. Commercial tax-free security, the company will pay the tax. So how to calculate the gross interest for government security? Gross interest is equal to face value into rate by 100. Face value into rate by 100. If it is a commercial tax-free security, first you have to calculate net interest. Net interest is equal to face value into rate by 100. After calculating net interest, now you have to calculate gross interest. The gross interest is equal to net interest into 100 by 90. Remember this. Gross interest is equal to net interest into 100 by 90. This is the method of calculating gross interest. Next comes explain tax-free perquisite. Some perquisites are fully taxable and some perquisites are tax-free perquisites. Tax-free perquisite means any benefit which is given by the employer to the employee. But Income Tax Act says this benefit is completely tax-free. No tax is applied. Example of tax-free perquisites are, first one, free refreshments provided by the employer to the employee during office hours and within the business premises. During office hours within business premises, if refreshments are provided, that's a tax-free perquisite. That's a benefit given by the employer to employees, but Income Tax Act says tax-free. Similarly, If the employer maintains a hospital to provide medical facilities to the employees or their family members, Income Tax Act says the employee is getting the benefit of medical facilities from the employer run hospital, then it's a tax-free perquisite. Similarly, if medical expenditure is reimbursed by the employer in a recognized hospital, if the employee got the treatment in a recognized hospital, then amount is paid by the employer. Income Tax Act says it is tax-free perquisite. So many examples are there of tax-free perquisites. Who is a person as per income tax provisions? Normally a person means an individual, natural person, just like I'm a person, you are a person. But according to the provisions of Income Tax Act, there are 7 types of persons. The persons includes individual, then firms, then individuals, then Hindu undivided family, HUF, then firms, then companies, then association of persons, then body of individuals, every artificial juridical person. Those 7 types of persons are there, and the persons have to pay the tax. That means tax is applied not only on individuals, but also Hindu undivided family, HUF, has to pay the tax. A firm has to pay the tax, a company has to pay the tax, or AOP, BOI, they have to pay the tax. That is person. Then what is standard rent? In case of income from house property, if the property is covered by Rent Control Act, then the Rent Control Act will fix the rent of the property. That rent which is fixed by Rent Control Act is called standard rent. Next comes what is casual income, unexpected income, or an income which is received with a chance element. All of a sudden, it is not a recurring income, it's a non-recurring. All of a sudden, suddenly, with a chance element, if the income is arised, that is called casual income. Example of casual income are winning from lottery, crossword puzzles, horse races, betting, gambling, television games, etc. These are called casual incomes. And for casual incomes, flat rate of tax, 30% is the rate of tax on casual income, without giving any basic exemption, and no tax rebate will be given for casual income. So these 10 questions which just now I explained are very, 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 very important questions, right? It is expected you may get many questions out of this. Now, the other important questions are, briefly I'll give the explanation of other important question. What is previous year? Previous year is a period of 12 months immediately preceding the assessment year. Our current assessment year is 2024-25 assessment year. For this assessment year, previous year is 2023-24. It begins from 1st April 2023 and ended on 31st March 2024. The income earned during the previous year is taxable in the assessment year. That's why it is called income year. If a newly started business, if a business is newly started, then previous year will be the date from which business started to 31st March next, right? That is previous year. What is tax evasion? Tax evasion is an act of avoiding the tax liability illegally. It is not legal, it is illegal. That means not showing the income to the income tax department, or hiding the income, or manipulating the accounts in such a way it will show no income or very less income. It is called black money. Normally it is called black money. That means unaccounted money. That is tax evasion. But Income Tax Act says if a person evades the tax, makes tax evasion, it will lead to penalty. Lot of punishment, penalty is there if tax evasion, because tax is a compulsory payment from the people to the government. Next comes what is total income. Income Tax Act has given the procedure of computing the total income. Income Tax Act says all the incomes should be divided into 5 heads. The 5 heads are income from salary, income from house property, profits and gains of business or profession, capital gain, and income from other sources. The total of these 5 is called gross total income. From gross total income, deductions are given under section 80C to 80U. So gross total income minus deductions under section 80C to 80U, you will get total income, right? Next, write about canon of equality. Canon means the principles to be followed by the government while making the tax policy. The tax should not be a burden or should not lead to obstacle to development of the country. The tax should be such that it should not be a burden on the part of the taxpayer, and also the tax should lead to the development of the country. So those principles to be followed while implementing tax policy is called canon of taxation. So Adam Smith has given 4 canons of taxation. The first canon of taxation is canon of equality. It means that tax should be in proportion to the income of a person. That means if a person is having more income, more tax should be applied. If a person is having less income, less tax should be applied. According to the ability to pay, the tax should be imposed. The tax should not be equal on all. It should depend on the ability of the person to pay the tax. Rich people have to pay more tax, poor people may have to pay less tax. That is canon of equality. Explain the deductions under section 16. This will be there in income from salary. After calculating gross income from salary, 3 deductions are given under section 16. The first is deduction under section 16(1)(a). That is standard deduction. This is compulsory deduction for every employee who is having income from salary. The deduction is least of the following 2. Gross income from salary or 50,000 rupees. Write it down. Standard deduction under section 16(1)(a). Least of the following 2. Gross income from salary or 50,000. This is the first deduction under section 16(1)(a). Second, 16(2). EA deduction. Entertainment allowance deduction under section 16(2). Then 16(3). Professional tax paid by the employee. That is called deduction under section 16(3). So 3 deductions under section 16. 16(1)(a) standard deduction, 16(2) entertainment allowance EA deduction, and 16(3) professional tax paid by the employee. Explain the deduction under section 24. This 24 deduction is available for income from house property. So after calculating net annual value, 2 deductions are given under section 24. 24A and 24B. 24A is the standard deduction, 30% of NAV. And 24B is the interest on loan taken to purchase the house, to construct the house, to renovate the house, to repair the house, to reconstruct the house. So if loan is taken for purchasing the house, constructing the house, deduction will be given for interest paid on the loan. So 2 deductions. 24A standard deduction, 24B interest on loan. Then comes what is gross total income. The aggregate of income under 5 heads. Income from salary, income from house property, profits and gains of business and profession, capital gain, other sources. The total income under 5 heads is called gross total income. Write about house rent allowance, HRA. Sometimes an allowance will be given by the employer to the employee for meeting the house rent. It may happen the employee is living in a rented house. The rent paid is a burden on the part of the employee. So employer will give separate allowance called house rent allowance. When house rent allowance is received, exemption is given under section 10(13)(a). So this exemption is given only if the assessee is paying the rent and stays in metropolitan city or other city. Then the exemption is list of the following 3 amounts. Actual HRA received, B, rent paid minus 10% of salary, or C, 50% of salary for 4 metropolitan cities, Delhi, Mumbai, Chennai and Kolkata. If the SSC stay in any one of the 4 metropolitan cities, 50% of salary. If the SSC stay in other towns, 40% of salary. So HRA is exempted to the list of the following 3. Actual HRA received, rent paid minus 10% of salary, or 50% or 40% of salary. Next comes right about GAV. Gross annual value. This is the first step in calculating income from house property. The gross annual value will be calculated by considering the municipal rental value, fair rental value, actual rental value and standard rental value. So by considering these 4 rental values, we calculate gross annual value. From gross annual value, municipal taxes will be deducted to get net annual value. Next comes right about RPF, Recognized Provident Fund. Provident Fund is a social security scheme from the saving of the employees. The government has started this Provident Fund scheme where employers are instructed that from the salary of the employee, some amount should be deducted and deposited in Provident Fund scheme. Later on, at the time of retirement, the amount can be taken by the employee. So the provisions are every month the employee will contribute to RPF. Employer also contribute from their part to RPF. The amount will get accumulated. At the time of retirement, the contribution of the employee, the contribution of the employer along with interest will be paid to the employee. And recognized different types of providents are there. Statutory Provident Fund SPF, Recognized Provident Fund RPF, Unrecognized Provident Fund URPF and Public Provident Fund PPF. The Recognized Provident Fund is that Provident Fund which is recognized by the Commissioner of Income Tax. And this Provident Fund is applied in private sector and public sector. Then who is an SSC? The person from whom income tax or any other sum of money is payable to the income tax department. When a person has to pay tax or any other sum like interest or penalty to the income tax department, then the person is called SSC. The SSC may be normal SSC, deemed SSC or SSC in default. And sometimes even if the person is not liable to pay anything, but Income Tax Income Tax Act has started proceeding against that person, the person will be called SSC. Then what do you mean by allowance? Allowance is a fixed monetary benefit which is given by the employer to employee for a specific purpose along with basic salary. For a specific purpose, the employer is giving an allowance. Example, dearness allowance, city compensatory allowance CCA, or entertainment allowance, house rent allowance, children education allowance, meal allowance, then project allowance, marriage allowance. For a particular purpose, fixed monetary benefit will be given along with salary. That is called allowance. Allowance may be fully taxable or fully tax-free or partly taxable and partly tax-free. Next comes what is short-term capital gain. Two types of capital gains are there, long-term capital gain and short-term capital gain. If an asset is a short-term capital asset, the gain arising will be called short-term capital gain. So when we can say an asset is a short-term capital asset, if land or building or both are held by the SSC for 2 years or less, it is called short term. Example, a person has purchased a building and within 1 year or after 1 year but before 2 years, he sold it. The gain arising is a short term capital gain. Similarly, another example is in case of shares which are listed in a stock exchange. The period is 1 year. If the shares are sold within 1 year of purchase, it is called short-term capital asset. So for land or building or both, the period of holding is 2 years. If the assessee sold the land or building before 2 years, short term. After 2 years, long term. For listed company shares, 1 year before, below 1 year short term, after 1 year long term. For other assets, the period is 3 years. If an SSC hold the asset for 3 years or less and sold, it is called short-term capital asset. The gain arising on short-term capital asset is called short-term capital gain. Short-term capital gain is taxable along with other incomes like income from salary, income from house property, other sources. We add up and include, and slab system will be applied for short-term capital gain. Then write about EA, entertainment allowance. Sometimes employer will give entertainment allowance to the employee. Income Tax Act says a deduction under section 16(2) will be allowed. First of all, EA is fully taxable. First of all, you should not see whether the SSC is a government employee or non-government employee. Whatever EA received should be taken under allowances. Later on, we have to see in working notes whether the SSC is a government employee or non-government. If he is a government employee, then EA deduction under section 16(2) is allowed, which is list of the following 3 amounts. First, 20% of salary. Second, actual year received. And thirdly, fixed amount of rupees 5,000. The Income Tax Act has given the fixed amount 5,000. So 20% of salary or actual year received or fixed rupees 5,000, whichever is least. That is EA deduction under section 16(2). What is agricultural income? Income Tax Act has given special provisions for agricultural income. According to section 10, subsection 1, agricultural income is fully exempted from tax. But agricultural income will be considered while computing the tax on non-agricultural income. So if a person is having only agricultural income, completely exempted, whatever is the limit. But if a person is having agricultural income and also non-agricultural income, in that case, we have to club both the incomes in order to tax the non-agricultural income. There is a procedure. So when we can say an income is agricultural income, first of all, rent or revenue should be derived from land. The land must be used for agricultural purpose. Thirdly, the land must be situated in India. So if these 3 conditions are satisfied, then the income will be called agricultural income. What are the 3 conditions? First, rent or revenue should be derived from land. Second, the land must be used for agricultural purpose. And thirdly, the land must be situated in India. Next comes explain about the tax rebate under section 87A. Income Tax Act has given some discount in tax liability. That means some concession is given to the taxpayer under section 87A. That is called tax rebate. To whom it is given? For low income group. Example, if an SSC's income is below 5 lakh rupees, then he will be allowed a tax rebate under section 87A. So this tax rebate under section 87A is given only if the income is below a specified limit. The specified limit is 5 lakh rupees. If the income is below 5 lakh rupees, then tax rebate will be allowed under section 87A to the least of the following 2 amounts. Actual income tax or 12,500, whichever is least. This is under the old scheme, under the old tax regime. New tax regime says if the total income is less than 7 lakh, then tax rebate will be given to the least of the following 2. Actual income tax or 25,000, whichever is least. That is called tax rebate. What is surcharge? Surcharge means tax on tax. Additional tax will be applied. To whom additional tax will be applied? For higher income group people. A person whose total income exceeds 50 lakh, he has to pay surcharge. If a person's income is up to 50 lakh in 1 year, during the previous year the total income is up to 50 lakh, no surcharge. If it crosses 50 lakh, then surcharge will be applied. So first of all, we calculate the tax on the total income. After calculating tax on total income, we have to add a surcharge. The rate of surcharge is 10% if the income exceeds 50 lakh but up to 1 crore. 50 lakh exceed more than 50 lakh but up to 1 crore, 10%. If the income is more than 1 crore but up to 2 crore, it is 15%. If the income is more than 2 crore up to 5 crore, it is 20%. If the income is more than 5 crore, it is 25. The different rates are given for surcharge. And surcharge will be there only if the income exceeds 50 lakh rupees. Then comes, what do you mean by incidence of tax? Incidence of tax means the applicability of tax. Section 5 of the Income Tax Act has given the scope of tax. The tax depend on the residential status of the assessee. That means which income should be included and which income should not be included. That shows the scope of the tax. Example, if the person is ordinarily resident in India, then he has to pay the tax on global income. Whether he earned the income in India or abroad, the total income he has to pay the tax in India. If he is ordinarily resident. If he is a non-resident, he has to pay the tax only on Indian income. The foreign income is not liable to pay tax because he is a non-resident. The incidence of tax shows the scope of tax liability. Next comes what is composite rent. Sometimes the owner of the house property, along with house, some additional benefits are given to the tenant. Example, along with the house, some furnishing is also being done, or some lift facility is given, facility is given, or maintenance is also provided by the employer and he charges separately for that. He is not providing only house. Along with house, some facilities are also provided and he will charge rent not only of the house but also the facilities. So if the owner of the house charges the rent of the house plus cost of the facilities, then the rent is called composite rent. Then lastly, explain the deduction of family pension. Actually, pension is the amount which is received by an employee after retirement. Before retirement, during service, employee will get salary. After retirement, he will get pension. So salary or pension, both are taxable, but sometimes the employer will pay the pension to the family members also on the death of the employee. For example, X is an employee. He expired. Then the employee is paying the pension to Mrs. X. This is called family pension. So if the family members of the deceased employee is getting pension, it is called family pension. So according to section 57, deduction will be given for family pension. If an assessee is getting family pension, that person will be allowed deduction for family pension. The deduction is 1/3 of the pension received or 15,000 rupees, whichever is least. That's all. So totally 20 points. So this 10 and this 20, 30 points I have explained. So watch the video 2-3 times. Definitely you can be able to get the complete command for attempting the short questions for this income tax. Inshallah, next video I will give the problems for these short questions. Only short questions problems I am going to explain. But unfortunately, what I am seeing, many of the viewers, my views are increasing. Many viewers are watching my video, but they are not subscribing. Subscriptions are very less. I don't know why. Why the students are hesitant in pressing the button for subscribe. Please. It gives me more motivation that my subscribers are increasing. It gives me more motivation to give you more and more better videos for your benefit. So please do subscribe. Share my channel among your groups, among your friends, so that more viewers can, more students can benefit from this channel. And also, please do subscribe. Inshallah, we'll continue the problems in the next video.